Good evening. This is our last class. It's bittersweet. I'm sure you're happy it's over, but you're going to be on your own after this class. I will be working this weekend. It means I will be receiving email. If you do have concerns, questions, you can email me. If you really need some help, I can meet with you possibly. But really, most of the things are in the videos. Most of what you need are in the videos or in the MyLab Finance. One student sent me this question. I thought it would be worthwhile doing this together. Did any of you try this problem and have questions about it? This is 12.6 from MyLab Finance. I thought I'd also take the opportunity to show you how I can use Excel very easily to solve these types of problems. Hi everyone. Only 16 of you. We'll wait a little longer. So can you read that? Is it too small? I'm going to see how it looks for you. Is it blurry? Does it look blurry? Oh my goodness, what a blurry stream. Why so blurry? That's awful. From my end, it's not so blurry. Okay, let's see if I make it bigger. Is that better? I guess, I don't know, just blurry when it's smaller. Okay, so that's 12.6. So, you want to give it a try? I give you a couple minutes. I'm going to give you a couple minutes just to see if you can sort it out and what's expected of you before I continue. I'm going to go, after this problem, I'm going to go straight into the Module 7 material. That's what I'm going to spend time on today. The TA did an excellent job with the options topic. So I'm going to ask those who did not attend the lab to watch the lab. He solved all the problems that I shared with you. And I'm very pleased about that. So I don't want to spend more time on it in class. So rather, I'd like to go on after this to the material I just emailed you, the capital structure topic. So how do you go about answering this question? Anybody have an idea? Right, Lenora, you need to see the table. Okay, so what I'm going to do is open up. I'm going to show you the table. Here's the table. Okay, so you can open up the table. There's the table. It's okay, Tony. So there's the table and the question. If you're on your computer, you can take a screenshot and work with the screenshot. What I'm going to do is put up my spreadsheet with this information. So what I did was copy these numbers into a spreadsheet. All right. So I copied these numbers into a spreadsheet. And there's a spreadsheet. So there's a spreadsheet The first three columns are the spreadsheet for with the information entered that you just saw. Okay, that's the table. And what you need to do is create this column. What do you call this column? Does anybody know? If I multiply the price times the number of shares outstanding, what am I creating? What am I calculating? Okay, Muskan is asking if he gets to use his book in the final. Yeah, you can use the book in the final. Just, you don't want to be wasting too much time flipping through things, right? You need to have everything prepared on pages near you. That's my greatest recommendation, is to have your formulas near at hand. Not flipping through pages of a book unless you've tabbed all the pages in a physical book. Okay, so and then Faisan asked about the weighting of the midterm. No, it's cumulative, so there'll be, it should be spread out for all the different modules evenly. All right, so the new stuff is, well, I should put a little bit more weight on new stuff. I'm saying that because I haven't made the exam yet, can you believe? So yeah, I'm not going to be biasing you in any way because I'm going to be working on it on Saturday. I have the exam questions, I just need to modify them to suit my style of teaching. So you'll see it'll look more familiar than different. So yes, Senna is right. This is market cap. Okay, what I've calculated in the third column is market cap. So we call this market capitalization. And I've taken column B times column C. So price times outstanding. So this is the total value of outstanding stock or equity for the firm. This is the S, right? And what we need to do for this problem is, okay, so this is supposed to represent the market portfolio. So in the market portfolio, there are 5 risky securities, 5 stock, and I need to figure out what proportion each is. So the total can be computed like that. Yashvi, you're asking about the lockdown browser, and I discussed it last class. Please watch all the videos, okay? If you haven't caught up, watch all the videos. But we aren't going to use the lockdown browser because there were some concerns. It triggered some students. They had bad experiences locking down their exam and not being able to get back in and losing time. So we're just going to have like a Zoom meeting where you're going to have a camera, and I'm going to videotape the session, viewing all of you on camera somehow. That is the plan. So I have to figure out how to do that too. But I will be in touch with the details on the weekend. Okay, so this amount is the total. So this is the total. This is the total value in our portfolio, okay? The value of the portfolio. And then what I'm going to do here is calculate the market cap divided by the total to get the share that each stock is represented in the proportion investment in each share, okay? So this stock A has like about a 6% weight in the portfolio. The stock B has a 22% weight. Stock C, almost 1%, so it's very little. Stock D is about 15%. And stock E has 57%. So lots of stock E in there. So you got what I did here? And the total weights should be 1. And if you see the nature of the questions, let me click back to the questions. What I want to do with this information is answer these questions. Oh, questions gone. I have to view. You want to view the questions? Here they are. So how much have you invested in stock A? How many shares of B do you hold? And if the price of stock C suddenly drops to $5, what trade in stock C do you need? So let's do the first one. How much have you invested in stock A? So with this table, if you have invested $25,000 in stock C, how much have you invested in stock A? That's the question. So if you invested $25,000 in stock C, if you've invested $25,000 in stock C, how much have you invested in stock A? How do we figure that out? Sorry it bounces around. That's when I try and see my other screens. Oh my goodness. So I filled in some of the other information here. I created other columns. So this is the total dollar investment. The dollar investment for each security. If I figured that out from taking the $25,000 that's invested in C, so $25,000 is invested in C, so that means because the price per share is $10 a share, that means 2,500 shares of C were purchased. So I'm going to get to all this stuff. I'm going to mark it in red. These are answers that you don't know yet, okay? So let's just look at I have the answers already on here, but I want to look at first look at the black, okay? So we got the information on C, and from there I figured out 2,500 shares of C are in this particular investment. And you're told that the investment portfolio has the same weighting, has the same proportion of shares, so it holds the same proportion as the market portfolio, however less has been invested. So I figured out from there that first of all, if 25,000 was invested, and I know that the proportion should be 0.00734 of this total here. So I'm gonna highlight the important information. I'm gonna put a border around it. So these numbers here that I'm putting a border around, the proportion of C is small. It's 0.007. Out of the total, that means that you can figure out from there. What I've done here is made an equation. I said, well, whatever, I'll make it bigger. Okay, whatever the market value of the portfolio is, times this 0.007342, that turns out to be $25,000. So when you solve this, you take the 25,000 divided by its fraction, and you figure out the total investment Let me go back to the question. Let's read the question again to remind ourselves what we're doing here. So it says, suppose you're holding the market portfolio shown in the table and you've invested $25,000 in stock C. How much have you invested in stock A? So if you're going to have if you're invested in the market portfolio and you've invested $25,000, in stock C, then you can figure out that the total investment for your portfolio, the total amount is $3,405,000 by making that calculation. And then once you do that, you can use this total to figure out, using the weight and this total value of the portfolio. So this is the total investment. All you need to do is take the share, the percentage or the weight, and multiply it by the total investment to figure out how much was invested in each of these. And that's how you figure out all the red in that column. Are you following? So here's my formula. I take this amount, I take the weight and I multiply it by I think I just put the number, this amount, in J4. Where did I put it in J4? Yeah. So I just multiplied this by that total, 3,405,000. I just put it over here. Which is confusing, right? So anyway, I'll try not to confuse you. I'm just going to stick with the columns. So each of these are computed by taking the weight times 3,405,000. You see? Okay, so now I figured out these. Do you have any questions? Are you guys asking me anything? So that's how you figure out how much is invested of each stock. The next question is about how many shares of stock B do you hold? So when it says you're holding the market portfolio, you're holding those stock in the same proportion as are available in the market. Okay, so you're always finding using the ratios or the weights in the overall market, the market cap for each company. So how many shares of stock B do you hold? So you can figure out shares by this column here. All you have to do is look at the total investment that you figured out just now and divide by the price. So this is the total investment divided by the price. Well, that tells you how many shares you've purchased, and you can do that all the way down. So I've taken this amount, divide by this amount, price, and I find out there's 25,000 shares of A, 35,000 of B, 2,500 of C, and then and so on. You see my calculation? You see my formula here? Any questions? The 25,000 was gone at the beginning. That was the problem. You should screenshot the problem so you can follow along if you haven't seen this problem already. Let me show you that problem again. So the number of shares of stock B would be 35,000. Then it asks you, I don't have question C, at the top. If the price of stock C suddenly dropped to $5 per share, what trade in stock C do you need to execute to maintain I gotta get that image. Okay, so that's what it says. Let me make it smaller so you can see it. Well, maybe not. Okay, so if it suddenly drops to $5 per share, what trade in stock C do you need to execute to maintain your portfolio at the same proportion as the market portfolio? So what do you have to do? If the price drops and you want to maintain those percentage or those weights, you have to buy more of stock C. To maintain those weights. So what I've done here now, these other ones shouldn't change because their price didn't change, but I need to double, right? Because the price went down by half, I have to double the number of shares. So rather than 2,500 shares, I buy 5,000 of, did I say C? Is that for C or B? Yeah, that was for C. Okay? So you guys, I just created this spreadsheet and did everything in the spreadsheet. The whole point is working with the market cap to calculate the weights, and then using the weights for your portfolio, you figure out what value, what amount, total amount has been invested, and with that you can figure out all of the total investments and then answer the questions about either a number of shares invested or if prices change, how that affects the number of shares invested or purchased, or the number of shares in your portfolio. Okay, I hope that's okay. You guys, you can review that. There it is then. I thought it was a good problem because I talk about these things loosely and these weights, but that's how you apply the weights in a practical problem. In reality, the market portfolio would have a lot of securities in it, right? But this is tractable. This is easy for you to work with if it's just 5. Okay. I am going to, so how many people get that or got that or did that already, or any comments? Oh, you want the spreadsheet? Sure, I can send you the spreadsheet. No problem. I'll put it on my list. Okay. Were you able to do this without this help, or was this helpful? Some of you might not have done this problem. You should be able to do a problem like this. Most of the problems you can answer if you have enough confidence and time, you have good enough sleep. Make sure you sleep for the final. Can I speak a bit about the last assignment that's due tomorrow? If you guys want more time, I can give you more time for that. Nobody's complained. The thing is, studying for that, you're going to be studying for the final, right? Trying problems. Okay, how did I get 3 million? Yeah, but I can't give you too much time. So what I'll do is the exam is on Monday morning, right? So what if I give you Monday night, the 17th, make that last assignment due? Right. Thank you, Kamal Preet. Exactly. I have this expression there that helps you solve for that 25,000. This one here. It's that the proportion, the weight, times the market value of the portfolio is equal to the $25,000. Okay, so I'll send you this spreadsheet. Okay, let's look at M&M, Modigliani Miller, the propositions, and what we're talking about is capital structure. Oh, there's only 4 questions in chapter 30. Just do let me see something. Just going to check the course outline. I'm going to check about chapter 30. Yeah, just do the questions that are relevant. Yeah, that's fine. That's fine, Senna. Because you're only doing 30.1 and 30.2, that's right. Okay. All right, so let's get to the notes. Capital structure. Okay, so the business of capital structure is we're going to talk about the objective of the corporate, the objective of the corporate structure is to maximize value, right? Maximizing value. You want to make this pie that includes equity and debt financing. Their balance sheet assets are equal to debt plus equity. So you want to figure out, we want to look at the theory around maximizing or getting an optimal V, and whether that depends on how you combine or how you structure the relative proportions of equity and debt. Does it matter? And to maximize the value of the firm, should management be aiming at maximizing the value, or is that synonymous with shareholder equity? S. So that's the first question. And then we're going to turn to the question of whether the debt equity ratio will actually maximize shareholder value. So clearly these are all interdependent. But it comes to the question of what should be our focus. And we begin with an example. I'm going to use this notation. You're going to get used to it. So you're going to see it a lot. The U is for unlevered. So this is a firm that's all equity. Okay, so imagine an unlevered firm with a value of $1,000. So it has no debt. Therefore, the value of stock outstanding is 1,000. If there are 100 shares outstanding, then the stock price must be $10 a share. So imagine this firm issues debt. So now they're going to convert into a levered firm. They're going to issue debt of $500. Excuse me 1 second. Al, about the American options, I think I'm pretty sure they were discussed by the TA yesterday. Did you see the video on American options, Al? Yeah, he solved the problems and discussed it in yesterday's class. At the end, if you need me, I'll go through. I'll repeat what was said. Okay, back to this. Okay, so now this firm borrows $500 and uses the $500 and distributes it equally to the shareholders as a dividend. Okay, so the shareholders are getting something with the debt issue, but now there's the reality that they have creditors. As owners of the firm, now they have to think that they have other obligations than themselves to be paid. Besides just taxes and other expenses, now they've taken on the expense of creditors. So what could happen? I give an infinite amount of things can happen, but I'm just going to show 3 scenarios. So we're going to look at the 3 scenarios, the best case situation in terms of the value of the firm. So let's say this is perceived by investors as a good thing. The value of the firm increases from 1,000 to 1,250 as a result of the share price being being bid up. Okay, so people are attracted. They see this as a more valuable than it was before. In fact, this is lower. Sorry, this is I'm looking at Al's comments. Oh, you had to leave Al. Yeah, he discussed it. Watch his video. Okay, sorry. So the value of the firm has gone up from 1,000 to 1,250. How is that? Well, 500 is attributed to the debt. And by taking the difference, you see shareholder equity appears to have gone down. However, you'll see in the table below, in the chart below, that there's a compensation. Remember, they got $5 dividend for each share, right? So let's continue. So the next case, this is no different. The value stays the same, where debt we discussed was 500, and that leaves shareholder equity at $500. The worst case scenario is that the value of the firm drops, where the debt finance was $500, and that leaves $250 in shareholder equity. Okay, and you compare that to the original. That's why I call this first column the best case scenario. So how do payoffs look in terms of from the perspective of shareholders? Dividends across the board, I said they were going to share $5 a share, which is for 100 share outstanding. That's $500 total. The value of the firm went up, so that's a capital gain. Sorry, the value of the firm went up, but the shareholder value went down, so there's a loss of $250. So that registers as a negative capital gain or a loss of $250. When you look at the capital gains offset by the dividend, the payoff is positive in this scenario. In this scenario, things stay the same. Whatever was paid in dividends was lost in market value of stock. And in this scenario, it's the worst case scenario. The loss is the worst. And so capital gains plus dividends as a loss of negative 250, or a loss of 250. So what I've done is divided the three states of the world. The possibilities are, and I just use one number as an example, a set of numbers, but the scenarios are if things were to stay the same as a result of debt financing, things would be better or worse. And you see the most important thing to derive from this is that when the value of the firm changes, shareholder equity changes in the same way. Okay? So when the value goes up, shareholder equity goes up. When the value or the payoff to shareholders goes up. When the value stays the same, there's no change to the payoff to shareholders after the restructuring. And in the worst case scenario, also that affects the shareholders directly. So when the value of the firm is high, so is the value of shareholders. Shareholders should be concerned with the firm's value. So they're directly affected by the value of the firm. So in answer to the first question, should management who are preoccupied with shareholders and keeping shareholders happy, should they aim at maximizing V or S? So it turns out that they are the same. Okay? So that's my example. Any questions? So these are made up numbers, but the idea is to show the effect on shareholders is influenced in the same way as the value of the firm. All right, no questions? All right, so what you want to look at, just to be clear, is this and the results and this. So there's three, so this firm is looking at restructuring, okay? So they decide they're going to restructure. They're going to take on creditors. So I'm repeating what I said. So they're going to take on creditors. They're going to finance borrowing $500 and taking that money, and what are they going to do with it, right? There's different things they could do with it. Let's say they gave it right to the shareholders. So they give it as a dividend. So they distribute it evenly, $5 a share to the shareholders. So that's $500, right? So across the board, whether things stay the same, they're worse off, or in the best case scenario, this is B. So think about shareholders. Shareholders might not like this, that they now have the firm's taken on debt, and now they're going to be responsible. The firm will have to pay creditors before shareholders get their cut, their residual claimants, right? They get their cut, they get their possible dividend, or the profits, any profits might be reinvested in the firm. Now that creditors are taken on as they've loaned money to the firm has to pay them their interest payments, possibly, or however it's been set up. They have to get their money back. They have to pay them. And with that in mind, it could be that shareholders don't like that and they perceive the firm as less valuable. Okay, so it could be worst case scenario, shareholder equity drops. Best case scenario, it doesn't drop that much. Remember, shareholder equity was 1,000, so these are all dips. And in the middle case, I say the same. So why do I say the same? Because it's clearly different, right? 1 to 500. Well, you have to think about the fact that there were dividends distributed to shareholders. So that's what the second table is for. So now it shows putting together the dividends. So here are the dividends, right? Here's the capital gains because the stock price fell. So these are totals, right? These are totals. So the stock price went from, or the stock outstanding went from $1,000 to $750. So that's a capital gain loss of, or a negative 250. In the second case scenario, went from 1,000 to 500, so that's a negative 500. And in the worst case scenario, that's from 1,000 to 250, so that's a loss of 750. When you add it up, these are the payoffs. And the conclusion is that when the value of the firm is high, so is the shareholder value. When it's the same, so is the shareholder value. Didn't change. There's no extra payoff. And when it's worse, so is the shareholder payoff. Okay? So what you do to the firm, you do to the shareholders. They're the owners of the firm. Okay, now the second question. So yes, in this table, the most important thing is that these match up. in terms of the pattern. Okay. So why would a firm take on debt? Well, because they can only raise so much money from shareholders. And they decide at a lower return that they pay to creditors to borrow money. Now the question is, how much debt? How much debt? Is there an optimal level of debt? Is there a level of debt that no one should surpass? And how would you figure that out? That's the next question. What is the right debt to equity ratio that will maximize shareholder value? So there's some theory here that you have to learn. Again, we have abstractions. From the abstractions, I add a little more realism, and we can see, we can anticipate some things about, in certain scenarios, in certain conditions, we can anticipate results. So you'll see what I mean as we go through this. So Modigliani and Miller were two financial economists who looked at this question. They published their work in, I think it was the 50s or 60s. And they began with a proposition called Proposition I, a world with no taxes. This is important, remember, because the incentive to have, to take on debt, to borrow money, you're paying, a firm would be paying creditors at a lower rate of return, and also those interest payments, remember, are tax deductible. So there's tax savings that accrue as a result of borrowing money. So we have to take that possibility away to begin with. We're going to take the benefit of debt away, and we say there's no taxes. So we begin with no taxes. In this situation with here are the other assumptions, okay? Some other very unrealistic with assumptions, but okay, here it is. There's no risk of default, okay? So there's no chance that the firm is going to default, that creditors won't get paid. We assume that cash flows are perpetual. And that's going to help with, you'll see the formula that we're familiar with, the perpetuity formula, is going to be useful here. So cash flows like the dividend that accrue to, or that are expected by shareholders, they're infinite. They're indefinitely anticipated. So the corporation, in other words, can exist forever. Firms and investors can borrow and lend at the same rate. That's another assumption. Now, that's not necessarily the case in reality, but we're going to assume that, so you can see we're going to derive a result. And there are no taxes. Okay, so these are the assumptions of the M&M model, Proposition I. So consider two firms that are identical in every way, except that one is levered and the other is all equity. I put them in the two columns. The unlevered firm has $1 million value, and that's then, so the shareholder equity is $1 million, and there's no debt, right? The levered firm, let's figure out what's the value of the levered firm and shareholder equity if debt is $400,000 with a interest rate of 5%. This is a yield to maturity on the debt. Remembering that we're going to assume that firms and investors can borrow and lend at the same rate, and there are no taxes. Should the value of the levered firm be higher, lower, or the same as the unlevered firm? That is what we're going to answer. Can you guys see the whole screen? I just want to make sure you can see the whole thing. Looks like you can. Okay, so this is another table. I'm going to walk you through this. Consider the following two investment strategies. Strategy A, for an investor interested in the levered firm, let's say they buy 10% of the levered firm. So they're 10% owner in the levered firm. That would be 10%. I could also write it, the dollar investment would also be this. Okay, so that's how much they've invested in the levered firm. I could write it as 10% of SL or 10% of VL minus BL. You'll see this notation a lot. That's just the difference, right? Because B plus S makes V, then S is equal to V minus V. Really, the math here is arithmetic. What's really important are the formula, not so much the calculation. Because it's a lot of arithmetic here. Okay, so that's the total dollar investment. And then the dollar return would be what? Well, let's use Y as the net income of the firm. And then we're going to take off, now there's no taxes, so I don't have to talk about taxes, but we got to take off the payment to the bondholders, right? RB times BL. We have to pay our bondholders. Remember, it's 5%. I put some numbers here. 5% of 400,000, so it's 10% of that amount. Make sense? Right? Because a shareholder can only get, the max we can get is the difference of the net income and a payment to, interest payments to bondholders. There's no taxes, so I'm not even going to say after taxes here. And so this is the dollar return when you do the math. I could have used different numbers, but this will suffice to show what I want to demonstrate. Okay. Look at strategy B. So this is an alternative investment that could be pursued. So, and I'm going to show you how they are the same. The investor could buy 10% of the unlevered firm. So basically, this is the guy, strategy A is investing in the levered firm. And looking at investing instead in the unlevered firm. But to get the same dollar return, what this investor could do, is they could borrow on their own account. They can borrow 10% of the same amount that the firm borrowed, right? Because investors can borrow at the same rate as the firm. So they can borrow 10% of BL. And when you put that together, this is the dollar investment. And then we can figure out the dollar return. They get 10% of the payout to the unlevered firm. The same net income, Y. And then they would have to pay back the money they borrowed, 10%, at that same rate. We're only having one rate, like we've simplified this, or like I said, made it very abstract. So firms and investors can borrow at the same rate. So let's say the ideal rate is 5%. So when you figure this out, this, if you calculate this with the numbers I gave you, I can't highlight it. Okay. So if you calculate this with the numbers I gave you, this is also minus 2,000. So when you put it together, you get this amount. You see here that the dollar returns are identical. Another big assumption is that we're operating in an efficient market, and there should be no arbitrage opportunities in an efficient market. So that means that if the dollar returns of these investment strategies are the same, then so too the dollar investment must be the same. I'm not sure if Yu Chen discussed it like that when he talked about put call parity, but it's the same sort of approach, right? If the dollar returns are the same, then the dollar investment must be the same. Did he mention that? So when there's no arbitrage opportunities, that is the case. So because of that, it turns out, and because I guess we've assumed that the net income for both firms is identical. I know this is about, I'm just looking at this, sorry a second. The unlevered firm has a net income of Y, and so does the levered firm. So given all those assumptions, it turns out that if you take these two amounts, this one here, the dollar investment for strategy B and the dollar investment for strategy A, it has to be the case if these are the same, then the levered firm's value and the unlevered firm's value must be identical. So we conclude that the firm value is not affected by leverage, and mostly because of all these assumptions we've made, including there are no taxes, no risk of default, that individuals and firms can borrow and lend at the same rate. So you can construct, an individual investor can construct their own debt. They don't need to do it through a firm. Or they could, yeah. So you're going to see this chart a lot. On this axis, I have the debt to equity ratio, B over S. So I'm going to work with B over S rather than B over V in this module, and I'll show you how to deal with that, okay? It's not a big, it's more complicated. It's less complicated than it looks, let's say it like that. It's less complicated than it looks, but B over S is going to be on the horizontal axis. So this is debt to equity, and then on the vertical axis is the value of the firm. And no matter what the debt to equity ratio, so debt doesn't matter, the firm values are identical. So what does this say about the required rate of return? M&M Proposition II, with no taxes, is focused on the required rate of return. In this case, because they're debt, we're talking about debt and equity, the WACC is that hurdle rate, or that cost of capital, the weighted average cost of capital. So I can write it like, you guys are seeing my notes as opposed to the PDF. It's easier for me to mark up, so I apologize if you see all these underlinings. It's probably because I have it set up in language of Spanish. Let me change it to English. Language. Yeah, see, it's in Spanish. Let's make it Canada. Does that gonna help? I don't know. Anyways, sorry, don't mean to distract you. Okay, so this is the WACC. Remember this? There's no debt, so I don't have to have the 1 minus TC. Sorry, there's no taxes, so I don't have to put the 1 minus TC beside the cost of debt. It's just a simple weighted average. Now, if I take this expression where return on equity is here inside the expression, and I rewrite it, so this is the value, this is the return, the weighted average cost of capital for the levered firm, right? Because if there was no leverage, I wouldn't have this second term for debt. So I want to solve this in terms of RU. I want to rearrange this and create this expression. You see, that's where my debt to equity variable comes from. And you see here, can you guys do that, algebra? By the way, rearrange this expression to make this one. Can I give you a minute to do that? Let's see if I can. I never did fix my iPad, but I found a new whiteboard to work with. Okay, so we have RU I'm gonna make it big and then make it small. Can I do that? So I want to solve for RS. You guys watching me? You see? Got it? How's that? So what does it say? What does this expression tell me? Any comments? Any comments? No? Okay, so this is the debt to equity ratio here. And what does it show about the relationship between the debt to equity ratio and the returns to the required rate of return to stockholders? It shows you that the higher the debt to equity ratio, where this will always be a positive, right? The returns to investors in the unlevered firm should be greater than the return to debt, right? Because this is all equity and this is the debt return. So this should be positive. So this whole term, as the debt to equity ratio increases, the required rate of return to stockholders goes up. So this reflects the notion that, well, if they're going to have to share the wealth, stockholders are going to require a higher rate of return. Yes. Okay, so this is in the same firm. Sorry, this is relative to the unlevered firm. With all the assumptions, don't forget we had all those assumptions that we made. So the cost of equity has two parts. The business risk, the risk inherent in the firm's operations or the beta of assets, and this will be known as the financial risk from financing with debt. And basically it goes up. It's a positive relationship. So you see that in the next graph. So what you have here is, you see the WACC is always above RB, okay? That should be understandable. That the equity, the shareholders have a higher rate of return than the bondholders because of what we discussed in terms of risk, higher return. The shareholders have greater risk because they don't get paid first when there's creditors, or they don't get considered. They get their residual claimants. And then we have this expression for the return on equity here. Okay, so it's the same horizontal axis, debt to equity ratio, but now I'm plotting the cost of capital. So for the unlevered firm, remembering that the value of the levered and the unlevered firm are identical in Proposition I, so the return to investors in the firms should be identical. The WACC should be the same as RU. That's the big assumption from the outset that I don't think I overemphasized. So those are the same. However, the return to equity, that return to shareholders in the levered firm, is influenced by the debt to equity ratio. The higher the debt, the higher required rate of return for shareholders. All right? Is everybody okay with that so far? So that's M&M Propositions I and II. The first one was about, with all those assumptions, which you should know those assumptions for the test, the value of the levered and unlevered firm are identical. In the second part, since that's identical, then the WACC must be constant, no matter what because the value of the firm doesn't change, the required rate of return for the average investor shouldn't change. So the WACC, or RU, should be equal to the RL. It doesn't say RL in here, but this could also be RL, but I don't write that. It's not usually in the theory written, but that's what it is. The WACC is the return to investors in the levered firm, the average investor, right? Partly a stockholder, partly a bondholder. And the second result demonstrates what the sentiment that with greater debt, the required rate of return to shareholders in the levered firm is increasing. Okay. So now, let's discuss the effect of interest. Sorry, the effect of taxes and the interest tax shield. We are assuming assuming perpetual cash flows, no depreciation, so we're not going to deal with CCA tax shield stuff, okay? And no fixed asset or net working capital spending. So remembering back to capital budgeting, I'm not going to include that. I'm just going to talk about perpetual cash flows. So a firm is considering going from zero debt to $400 of debt. The earnings before the unlevered firm, the earnings before interest and taxes, let's say it's $200. And we'll keep it the same. So just like in the first example, my Y's were the same for the levered and the unlevered. Okay, that's another assumption. Okay, earnings are the same. I'm laughing because that's quite a strong assumption, but okay. Interest is 0 for the unlevered firm. Sina's asking, yeah, usually they'll refer to it as Proposition I or Proposition II, things like that. But whenever you have to discuss the M&M propositions, you need to know these assumptions. So write them on your formula, not your formula sheet, but your study sheets. It's not a formula to know the assumptions. Okay, so let's look at the effect of taxes. So there's interest payments that go to bondholders in the levered firm. The taxes at 40% on $200 is going to be $80. The taxes of 40% that go on 200 less 40, sorry, is only $64. So you see that there's a tax savings of $16. Okay, between this and here and here. So your net income after interest and taxes is still, it's $120 for the unlevered firm. In the levered firm, it's only $96, but in terms of cash flow from assets, which we care about, right? We care about cash flow in finance. There's a tax savings of $16, which we have to add in. Remembering, this is for each year. Imagine if that happens each year. In each year, if this was perpetual, if we imagine that the earnings before interest and taxes was always 200 forever, that's kind of the assumption we're going to work with, or that's the approach to solving some of these problems. So if this was perpetual each year, it would be, remember how you calculate tax shields, it's usually TC times the amount, and the amount is depending on how much debt there is. So for every dollar of debt, it's RB. So that's your total interest payment times the tax rate. That will be your tax savings in this case. Okay, so this calculation each year. So since that's each year, you have to do this, and it's forever. We're assuming an interest rate of 10%. We use the interest rate as though, remember, when we do discounting, we always think about what's the opportunity cost of this cash flow. In this case, the opportunity cost is RB. Because if we weren't investing, if we weren't doing this with this money, would have invested at a rate RB. That's the thinking. So this would be the discount rate we should be using. So it turns out that even though this is the expression for each year, you do this perpetually, and you get TCB. Got it? So stare at that a little bit. So this is our formula in the case that we have taxes. So we're going to put taxes back. We're going to keep the other assumptions, mainly that there's no risk of default. And this would be the expression for the value of the levered firm. It would be a markup above the unlevered firm value by this amount. The present value of the tax savings, perpetual tax savings, that would be the expression for it. So this formula is known as M&M Proposition I with taxes. So the one and the two have to do with looking at the value of the firm versus looking at the return on equity, cost of capital, cost of equity. Let me close the calculation page. Turn my iPad off. Make this bigger. Okay, so what next? So next is going to be you guessed it, the graph. So here you see the value of the firm in the case of no taxes. Now once I put taxes in, and notice I put on this axis debt, not debt to equity, because the formula has a B in it, not a B over S. So what it's saying is, what is it saying? Can somebody summarize what it's saying? I'll give you a moment. Tell me what it says. It's more meaningful if you say it. If you remember, you'll remember better if you could form the concept in your mind. It's both. Yeah, value is the value of assets. Yeah, Muskan, it's the same. Value of the firm or the value of the assets, same thing. So what does this say? And what is the implication of this result? What should you do if you are the CEO of this firm? Right, so what should you do, Kyla, as the CEO of this firm? Remembering this abstract world with all the assumptions and taxes, what should you do? Issue some debt, not just some debt, Kyla. How much debt? What's the optimal debt in this scenario? If you're the CEO, there's no risk of default. What do you mean? So all that the firm's value depends on is the value of the unlevered firm plus TCB. TC is fixed, it's just some rate. We'll assume it's the same infinitely through time. So the one choice variable here is the B. What would be the optimal B? What would be the best B? Anybody? Kyla? A 100% debt. Ben, right. All the way. 100% debt. So it should become an all debt firm, right? And not just 100%. Infinite. Because look at my axis, is total debt is on the axis. So it's not just a proportion. It's infinite debt. It's infinite debt. That's the implication of this model. Okay? Okay, let's see. Let's do this exercise. So taxes and firm value, an example. So earnings before interest and taxes is $100. TC is 30%. RU is 12.5. Senna's asking if we rearrange. All I wanted here, you mean over here? So here, you don't solve for B. What you're looking at here, because I didn't give you any numbers on this graph, I'm just saying, looking at it as a CEO, it looks like this is infinite. This explodes. Infinite debt, 100% debt. Basically, it should be an all debt firm with infinite amount of debt, because then the firm value could be infinite. It'll just blow up. You'll be a gajillionaire. That's the word. That's what the model's showing. So we're going to clamp down on this model. We're going to make it more realistic in a bit, because at some point there is risk of default, right? You can't just borrow $200 billion or $200 trillion and expect to pay it back, okay, with interest. So yeah, there's going to be limits, but in the world that we presented with those assumptions, this is the implication. All right, so let's try this exercise on this page. See if you can answer this. Think through it, and then I'll do it with you on my iPad. So what you need to ask yourself whenever you read this, what are the assumptions? So what we're going to assume here is M&M Proposition I with taxes. Okay, so we're allowing for taxes now, and the advantage, the tax savings from interest payments being tax deductible. So I want you to figure out VU, VL, and SL. What you're going to do I'm going to put my iPad back on. Oh, it didn't erase. That's funny. Why didn't it erase? Okay. Are you guys trying this yourself? So first, if the firm is unlevered, right? It's just going to be these earnings of $100 forever after tax. So this would be 1 minus 0.3, so this after tax. And then it's perpetual, so that's forever. So when you figure that out, that's the unlevered firm. So it's 70%. What do you get for that number? 560? So from the theory, the levered firm, very good. The levered firm is a markup above the unlevered by an amount because of what we figured out, perpetual tax savings. It's if you remember, the formula is here. TCB, okay? So we're going to add in TCB. So we went from 0 to $100 debt. With the tax rate staying the same. I'll keep all the numbers the same. Oops, that's not the right number. I want to put $100 debt. So the new value is going to be what? $590. Very good. Okay, so we have one thing left. Now let's calculate the new shareholder value, equity value. And we're always going to make these calculations, right? Because B plus S equals V. I can do this. So the equity value for the shareholders in the levered firm is now $490. Very good. So it went down, right? Because now there's bondholders, and this is a result. So those are the calculations you can make. So how does this affect? This is Proposition 2 now. How does this affect with taxes return on equity. What's the required rate of return now? If you take this expression now for WACC, right now we have the taxes, so that goes in there. No longer are the levered and the unlevered the same. You can solve this expression for this. You want to try that? And then in the questions below, I want you to solve for the return on equity for the above example and the WACC. So let's take a 5-minute break, and you guys can look at this. Let's get some water, and yeah, let's just take a 5-minute break. Okay, I'm back. Did you calculate any of these? Did you get any of these? So we want to calculate, okay, so first of all I asked you to solve for RS from WAC so you can solve just like I did before. To get that expression, right, that's the expression. If you set that to be equal to the unlevered firm, then you unravel it's getting messy. And just like I did before, multiply this up. So multiply across by S plus B. And then distribute this. And collect your terms. What we're going to do is isolate RS. So I guess I'm going to do like I did last time. RS and divide everything by S. Well, I'll just take that step. So I'm going to say moving this over there and then flipping it. Yeah, I'm just going to continue writing this and then do subtract. So BRU minus BRB, 1 minus TC. Okay. So then collect your terms and divide by S. This is the unlevered firm plus RU minus RB. Remember, U is for the unlevered firm. And then B over S, 1 minus TC. Okay, so that's where that comes from. Now let's use it. Let's first calculate the WACC using this formula, and then we'll use this one to get the return to shareholders. Remember, this is the return to the average investor in the levered firm, and this is the return to shareholders in the levered firm. Okay, so this is, you've got to partition them. You have to think this is just the shareholders, and these are part shareholder and part bondholder. Return to shareholders, some people calculate it. Osena did it. So using the values that we got back here, So WAC is going to be S, which was 490, over S plus B, or the value, which was 590, what's RS? I need RS first, don't I? And then debt is 100, and this was 590, times the return to debt was 10%. Go back again. Yeah. Oops. Sorry. This was 10%. And then 1 minus TC, the tax rate we used was 30%. So that's for WAC. So we need to get RS to be able to do this. So that's why you have to calculate that first. So RS, I'll do on the bottom. From the unlevered firm was 12.5. And then from the unlevered firm and the cost of debt, the debt to equity ratio and then 1 minus TC. All right, put that all together. You'll get RS, and then you put it in here, and you get WAC. Okay, you guys do it without me. Tell me what you get. Okay, so RS is 12.86. So remember, this is always going to be a positive because the cost of debt is always lower than the cost of equity, right? And yeah, so 12.86, and then you put that in here. What's your WAC? Keep all your decimal places. Save it or store it. Okay, so this is 0.11. Or 0.12. Let's make it a percent. Let me write it as a percent. Do you guys get 12%? Okay, you guys get the same thing. So 11.86%. Okay, so the first time you do it, it's a little long, and then you get the hang of it. So what's happened? So when the firm was all equity, the rate of return was 12.5%. So that was like the return, the cost of capital was 12.5%, right? And now, for the firm, on average, the average investor, the expected return, required rate of return, is 11.86. So that went down. And for the shareholders, that went up. So we need to reflect that graphically now. We're going to show that in general. That is the pattern. You see? What's really interesting, okay, so this is, we're used to this, right? So for the unlevered firm, it doesn't matter. It's a straight line because no matter what, the debt to equity ratio is always going to be the same. There's no debt in that firm. With debt, for shareholders, the required rate of return increases. For the average investor in the firm who went from being a shareholder to being part shareholder and part bondholder, because the optimal level of debt is 100% debt, the average investor looks like a creditor. The average investor looks like a bondholder, right? So their required rate of return approaches that of the bondholder. Get it? So that is the drawing for Proposition II, taxes, and with the axis of the debt to equity ratio and the cost of capital. Okay, so the WACC. So Kyla, as bondholders, as the average investor in the firm becomes more like a bondholder, the WACC goes down. You get that part. But the return to bondholders, the required rate of return, doesn't change because there's no because their return is set, right? It's set in their bond, in the indenture. It's set in their bond certificate. It doesn't change. However, because there are because now shareholder, from the shareholder perspective, taking on debt holders, they are going to require a higher rate of return. So it reflects that they want to be compensated for the higher risk of not getting paid. That's what it's reflecting. And that's why the required rate of return goes up. If you remember this like a story, it's easy to remember all these results. So what we got to do next is make this more realistic. In fact, we're going to remove, so what we do is when we create an abstraction in a model, we begin with that model and then we peel away the abstractions, making it much more realistic. So we're going to now take away the assumption of no default risk. And we're going to say now, what if there is a default risk? So that means that bondholders might not be paid. If bondholders don't get their interest payments, the firm is liable. They could actually contract lawyers and go after the firm. And they might force the firm they might be able to force the firm to restructure. And that is an added risk for shareholders. It might affect the share value, and it might affect any future dividends that they were counting on. It might affect the firm at large. And if it gets that distressed, we refer to this as a financial distress risk. We need to take account of it. Okay, so this result of M&M, Modigliani and Miller model with taxes it shows how debt provides that tax benefit to the firm. And the firm should borrow an infinite amount or 100% debt. Well, those are two different concepts, but 100% debt, but debt in the amount, there's no reason to stop, okay? But that's not realistic. At some point, there's going to be a cost, okay? There's a trade-off. So in reality, the firm has to pay interest and principal to bondholders. If the firm defaults on a payment to its bondholders, it will enter a phase of financial distress. Or ultimately, if financial distress persists, the firm will declare bankruptcy. And there are so many costs involved in both financial distress and ultimately in bankruptcy. Now, the firm might not have to shut down, but they'll have to restructure, and there's lots of costs involved in doing so. Okay, there's legal costs, there's operation costs, suppliers might not want to work with you, and customers might not count on you. Okay, so let's look at that. What is the effect? I'm going to turn off my iPad. So the cost of financial distress. There's direct costs, the legal and administrative costs of lawyers, accountants, and expert witnesses. There are the indirect costs, impaired ability to conduct business, lost sales because customers aren't counting on you, right? They're concerned that you're going to be able, let's talk about Sears. Sears went through a stage of restructuring and then bankruptcy. And they shut down many stores. They're still operating, but they shut down a lot of stores. And in the interim, why would anybody want to buy an appliance from Sears that wouldn't honor its warranty? So they've lost those customers. Then there's agency costs. So from the firm perspective, from the perspective of managers. So managers are not. They're not owners, but they might have stock options, right, with the firm. So they do care about the viability of the firm. They care about their reputation. However, if things are really bad, they might look out for themselves, and they might take risks they wouldn't have otherwise taken. So this is just a breakdown of their selfish strategies. So for the sake of stockholders, let's say, stockholders might pressure them to take large risks that otherwise wouldn't be taken. So they think if stockholders feel that, well, it looks like things are going to turn out really bad, maybe the firm will shut down. Why don't we take a chance, invest a lot, and well, if it works out, it's a gamble, but it'll be better for us in the short term or even in the long term. But on the other hand, the sentiment is, well, the company's shutting down anyway, so who cares? So that could be a selfish strategy. Stockholders might pressure management into taking. There might also be an incentive to underinvest, to carry on with projects or commitments that were made and just hold on to cash, or in Selfish Strategy 3 it mentions that they actually sell assets off, right, and then distribute those through dividends to shareholders. And then also managers might they might distribute some of the revenue from asset sales to themselves. So that could be in the terms of bonuses, and in terms of they'll find a way, whether legal or illegal, that'll play itself out. So this is in a state of desperation, these things might happen. So these are all costs, and they affect firm value. So we're going to adjust, we're going to augment the expression for firm value by subtracting at some point the present value of expected costs of financial distress that might set in. So there might not be costs initially, but at some point, at some level of B, there might be anticipated costs that you have to figure into your valuation. So this will deter you from having optimal debt. Okay, so this will stop a firm from having 100% debt or infinite debt. So for firms with low financial leverage, the probability of default is close to zero. Right? So that's going to be zero. So you're going to see I'm going to present to you some different expressions that will capture that property, that for low levels of B, that's not going to be a significant amount. For highly levered firms, the probability of default would be positive. In this case, a $1 increase in debt will increase the tax benefit at a cost of constant rate of the tax rate, right? But it will increase costs of financial distress at an increasing rate. So the goal will be then to increase debt. To find the optimal debt, you'd have to increase debt as long as the tax benefits exceed the present value of the cost of financial distress. There will be an optimal level of debt that we can find, B star. So this is just to depict what I'm talking about. So this is the Proposition I with taxes, right? That you have debt. It's untethered, boundless, all increasing. But this curve here would be more realistic. This would be a more realistic function for the value of the firm with debt. At some point, the benefit does not offset the cost of financial distress. So you would want to issue debt in the amount B star, this optimal level. So this curve is something that we want to introduce to our calculations, and I do that by presenting you like a expression for the value of the firm, and you can find this optimum. How do you find the optimal? How do you find the peak of that curve? What techniques would you use? I'll answer that in a second. This is now the accompanying graph for the return to investors, or the cost of capital, the cost of equity, and the cost of debt. Notice what's different here, and can you tell a story? What's happening here? Somebody tell me what just happened. How this looks different than the other one. Tell me what you see is different here. The x-axis is debt to equity still, Kyla. Well, it's different than, so I'm talking about this compared to this one here. What changed? So I want to compare. This has the same x-axis, the same y-axis, cost of capital, with the debt to equity ratio on the x-axis. But what happens, and tell me what is it implying? So what you see is the WACC is no longer straight. It starts to go up. After this point, with default risk, now that I've introduced the risk of default, the average investor, remember we said, as the average investor becomes more of a bondholder with default risk, even the bondholder is going to require a higher rate of return to actually invest in the firm. So you'll see, when a firm, so let's say, actually I have never looked at Sears and their stock price or their bonds, but it would be the case that a firm that's in financial distress will try to raise money if there are investors interested, they're going to require a higher rate of return for equity and for debt. Okay? So that's what that is reflecting here. And that has a dual effect of then influencing the WACC. The WACC will go up as well, because the WACC depends on both return to debt and return to equity. Okay, so the required rate to be a bondholder after some point, even bondholders are going to demand a higher rate of return. It's risky to even be a bondholder in this firm. So remember, this is the higher the debt to equity ratio. At some point, this even turns up, as will the WACC. Okay? So these are the patterns that I want you to practice, and these formula. Notice the WACC formula now shows that this term will kick in, a premium for cost of financial distress. This will be zero for low levels of debt, but after some level, at some point, there's going to be a higher rate of return required to actually invest in this firm, either as bondholder or as the average investor in the firm, represented by the WACC, cost of capital. Okay, so we're done with that. And let's look at some exercises now. So we're going to begin. Let's do review 1. So this review 1 will trace out. Yeah, Spencer, it'll give you details. yeah, you'll have the details to work with. Now, these are all the notes that I give to you, but in the exercises, I actually add additional information, because what we're going to do is, all I've done so far is assume there's just corporate taxes, but in fact, more realistically, there's other types of taxes, right? There's investors have to pay taxes on dividend income, and I've assumed that's zero. I haven't even included that here. So there's going to be some exercises in the handouts where I introduce that concept. And at the end, I've given you, it's not the end, but one of the last documents I gave you in order, it summarizes all the formula for you that you might come across. I guess I shouldn't start there, though. Where I'm going to start is, let's just look at the first hand. So 7.2, review 1. Let's do a little bit of this. I'll show this on my screen. Oh, it's way too big, isn't it? I gotta make it smaller. Okay. Alright, so assume an M&M world with no taxes, so that means invoke all those assumptions. The risk-free rate of return is 4%, and the market risk premium is 10% for XYZ Corporation. Is there supposed to be a period there? The market risk premium, we're going to put a period there. XYZ Corporation could be financed with debt and equity according to the proportions specified in the table below. Fill in all the missing cells. Okay, so we have here information on betas. And we do not have, we have the risk-free rate and we have the market risk premium. So what should we do? Where should we start? Any ideas? Any ideas, anyone? It's kind of a giveaway that I told you the market risk premium. What should you do? Yes, find RS using CAPM. Excellent. Okay, do that. Everybody do that. And then we'll take it from there. I'm going to put up my iPad. So you have the answers for all this stuff, but I know you appreciate when I make calculations to get you started. You've got an echo? Sorry. You want me to reboot? Let me know, guys, if you hear an echo. I don't know what I can do about it at this point. Okay, so use cap M. Interesting. It might be because I'm in a bigger room. Let's see if I can, maybe one of the settings changed on my microphone. Let me know if that's better or worse. How's that? Oh, this is so messy. I'm gonna do that again. This is a new whiteboard I'm not used to, sorry. That's a 0. Okay. So that's 5.2%. Do you guys see what I did? So then you fill that in the chart. Let me fill it in here. So that's 5.2%. What did I do wrong here? Did I do something wrong? 1.2 equity beta. Risk market risk premium is 10. RF is 4. Oh yeah. Okay, let me do this again. This is a mess. Alright. Alright, so this is 0.04. I'm going to use my finger. And then this is 0.12. Now I'm going to get it right. And then you add those and it's 0.16. Better? I don't know what happened. My calculations. Thank you. So that's 16%. So I'm going to put it as 16%. I'll make it bold. So now that we got that, what is the WACC? Without even doing a calculation, do you know what the WACC is? This is 100% equity finance firm, so all equity firm. It's unlevered, right? So WACC has to be 16% too. Very good. Continue. And so what would be the weighted average beta? It didn't change, right? It's the same as the equity beta. So it's also 1.2. Right? There's no change. Ready for the next one? So where should we start with this one? 80%. So let's find the, okay, we'll do that. Let's find the expected return on debt. How can we do that? What should we do? Use CAPM, right? So use this in CAPM. So this is for 80% debt. Oh, sorry, no, 80% equity. I said it wrong. I'm so out of it today, sorry. Said it backwards. So this is equity. That's really important. So you know that there's no taxes here. So RB is going to be RF plus, what is the debt beta? It's 0.12, right? Times 0.1, because that's the market risk premium. This is beta of B, and it's after tax is the same as tax, so that will be fine. This is 4. And then this is like that. And so return on debt is going to be 0.052 or 5.2%. Got it? Now what next? That's right, Senna. So because the WACC for an M&M world with no taxes, the WACC stays the same. all the way down. So these are all 16% all the way down. Doesn't matter how much, right? Because in this result, the value of the firm stays the same. So too, the value of the return, the cost of capital, or the return to the average investor in the firm is identical all the way throughout. So this also reflects the concept at the beginning that the shareholder cares about the value of the firm. So if the value doesn't change, shareholder equity doesn't change, the return to investor doesn't change. The return to the average investor in the firm doesn't change. Okay? So those are all the same down, and also, what else is all the same going down? If the WACC is the same, then the beta has to be the same because of the cap M. We assume, I didn't write it there, but we assume cap M holds as well. So this is the same all the way through as well. So look, we've narrowed our work down substantially to a few cells. So we're finished the second row, and we didn't even have to use the proportion to do it. Can we say that about the rest? What next? So this result holds, this result holds because we're in the M&M world with no taxes. Okay, let's find the equity beta for the third row. So the equity beta from this, using the cap M, oh, you said the equity beta. Do I have the debt beta? Return to debt? No, we can get it though. Okay, so the return on equity is equal to the risk-free plus the equity beta times the risk premium. So I give you the market risk premium. It just makes it easier to make that calculation. And RS is 23.2%. RF is 4. So this is what you solve. And what do you get? I get 1.92. Oh, something's happening to my computer. The circle. Oh, there it is. Okay, it's back. Took a little while. Okay, so then you can get the expected return on debt using the CAPM. So these ones are straightforward. What about, let's do this. Okay, let me, I do have the answers for all of these. What I want to do is something different. Do this one. This time you do not have equity beta. What do you do to solve for that? Okay, what about this one? The one I put the question mark on. I put a question mark. Do you see it? Right, you're going to use the new formulas I gave you to calculate RS first. So you're going to use so for column 2, when you're out of luck and you don't have a direct way of getting the answer, use this. Well, if you can't use the CAPM, say, or some weighted average for WAC. So use the debt to equity ratio. Now, I want you to use this formula, but we're at a crossroads that how do I get from the proportion, how do I get this, the ratio? So I need to know how to do that. Do you guys know how to do that easy enough? So I'm talking about S over B plus S is 40%. So what is B over S then? This is like the only real challenge of this assignment, part 1. Anybody know how to get that? You can tell me no, and I'll show you how. That's right, Andre. That's the way to do it. So that's how I'm going to do this. So as long as you're going from a proportion to a ratio, you can do this trick, okay? So S, exactly like he wrote it, is 40%. If S is 40%, take B as 60%, and then S plus B is, of course, 100%. Because when you add them, they make 100%. So if you do that little substitution, that'll get you the answer really quick. So you use, like, even if you use 6 and 4, that would work, but okay. So 0.6 over 0.4 would give you the debt to equity ratio, which he said is 1.5. All right, that's the trick. And that you'll need to put into your formula. So for column 2, that's what you're going to do. For column 3, it's pretty much cap M. For column 4, it's, well, we know that because of the fact that it's Proposition 1 with no taxes, we know WACC is always the same. For column 5, you're going to use cap M. So column 3, 5, and 6, you're going to use cap M. So Kyla asked, okay, so let me finish this. So 3, 5, and 6 use cap M. And then column 7, you can use cap M2 because you have the beta most of the time. So this is good practice for you. And now she asked, Kyla asked, what does RU? RU is the return to all equity firm, like the return to investors in an all equity firm, right? So no debt. So that's the 16%. That's why WACC is 16%. So RU. That's where we started. So remember, for column 4, we have the result that WACC is equal to RU no matter the amount of debt, since we have the first proposition with no taxes and VL equals VU. Okay, so that's that whole answer. Then what you're supposed to do in the next part, if you don't have questions, in the next part you have to graph it. So you're going to get the graphs that we saw in the notes. So you're just going to graph it here. You can try that out. I didn't even put the graph in the solutions. I don't know why. Might have had it there at some point. Or it was a little bit off. Or anyway, it's easier if you draw it by hand. Just I gave you the graph. And you can put it in there. Okay? And so what you should see is WACC is flat, the same all the way through, which you can see from the chart. And then RS is going up. And you see that here, right? This is going up. You can also see it in the chart. Okay, let's look at the next one. Oh, I started doing some here. Let me erase those. So now we're going to move to the world with taxes. So corporate income is taxed at 40%. And I give you the debt to equity ratio this time. I think you should be able to do this. The most important thing is column 2. Column 4. Well, you know how to calculate WACC. The rest is just capital asset price. So the only new thing is this column 2. How are you going to get this if you do not have equity beta? So here and here, right? How are you going to get this? So debt is constant, right? We assume it's constant, and the returns, the dollar returns, are perpetual, forever the same. Those are all the assumptions from the world with taxes. So the way you're going to do this is you're going to use for column 2 you're going to use the formula for equity, that is the markup for the investors in an unlevered firm that are all shareholders. They're all shareholders. Only shareholders in the unlevered firm. And then this difference, which will always be a positive, that will be the expression used for column 2. And the others use cap M. Okay, so you guys can work on that for practice. And then you can draw it. Just note that for column 7, remember that the betas and the return to debt, the cost of debt should always be after tax, right? So for column 7, I hope you guys are following. The beta of assets is going to be portion of debt times the weighted beta, but this is after tax, plus like that. And that's going to be where that's the after-tax cost of debt from the cap M. Uses the beta after tax for assets. Wait, is that for assets? What happened here? I have a typo. Column 7. This should say debt. Oh, it's good I showed you. And then this is the market risk premium, which in this example is 10%. Okay, so there's that. I'm gonna fix this. I'm gonna have to send this to you because I have wrong. I have the wrong formula in the solutions. So that's how it should be. Okay, you guys following along? So this is the new thing. This is the new thing here. This you should already know. And remembering that we use the after-tax beta when calculating the beta of assets and the WACC. Questions? Okay, so work on that. What next? We have 45 minutes. Let's see. So you guys can draw that and then use the data, I should say data, from number 4 and fill in the table below. S is the market value of equity. B is the market value of ABC's debt. And show the total value. Okay. So you guys should be able to fill in that table. So I have given you the solutions for that. Any questions about this one? Just got to work on that. You don't have to draw it, I mean. You should know the drawing, but you should verify that it looks like the way you expect. In this drawing, remember what it's going to look like. The WACC will be going down because there's taxes, but no risk, right, of financial distress. The WACC should be going down to the cost of debt. That's what you should see here. Oh, I'm not going to draw it. I don't have time. You guys draw it. But it's going to look, it should be going down. I mean, it's not going to be exactly, but it should go down. And it is, if you do the math. I'll show you the result when you make all the calculations. You see, there's the solutions, and what you see is the WACC is going down. As you put more and more debt, the WACC falls. And the lowest it's going to be, but in this case it doesn't, right? The lowest it'll be is it won't go below the return on debt, and the return on debt should stay the same. This is a straight line. So just remembering the notes. Right, it'll be like that. the cost of debt will be the same, and the WACC is falling. RS is going up. So that's what it should look like. So you don't have to draw it, you just have to sketch it. Just look at the chart and make sure it has the same pattern as your notes. So you guys can let me know if you're confused. Just send me an email. So work on that. And what do we have next? We have much more. So that was 7.3, 7.4. Okay. 7.475, 6, 7, 6, 7, 7. Okay, I'm going to let you guys work with those. What I want to get to is these type of problems. Okay, let's look at number 4 on 7, 7. Review 7, 7, 7.7. We really need to do this before we go. Okay, so question number 4 and 7.7. Okay. We're going to introduce now financial distress. So, everybody's got that 7.7? Assume the M&M model with corporate taxes and financial distress holds, and that CAPM is true. PCI is a corporation financed with debt and equity. $80 million of its assets are financed by debt, paying an effective annual return of 7% and the remainder with equity. PCI's earnings are subject to corporate taxes at a rate of 40%. A financial analyst has estimated that if PCI were all equity, it would have a market value of $500 million. And the return on investment in PCI's equity would be 18%. So those are the results for the unlevered firm. The financial analyst believes that there are costs of financial distress associated with debt, and she estimates the present value of these costs to be either one of the following. Okay, and the values for B are represented in millions of dollars. So for each of these, so these are curves. And if you know these curves, if you're familiar with them, it's helpful. If not, I'm going to show you what to do. So we want to calculate the market value of TCI under its leveraged capital structure in either case. Is there an optimal amount of debt for PCI in either case, 1, 2, or both. What's with the typos? I'm going to make that. Justify your answer. So for the second part, you actually have to take a derivative of the market value of PCI under a leveraged capital structure. Now, I gave you a handout with derivatives on it. I don't think you should worry too much because there's just a few that you need to know. It's just to remind you about calculus that you should have taken. And you don't have to know all of calculus to do this, okay? You just need to know what the derivative of these functions are. Because when we optimize the first derivative, the function of the first derivative set to 0 will be where we find the optimal value, okay? So that's going to be the idea. So let's do the first part. Calculate the market value of TCI under its leveraged capital structure in either case. How are we going to do that? What's the formula for the value of the firm? This is not hard, guys. What's the formula for the value of the firm? Someone tell me in the notes that we discussed. So we're in the last case, and there's 2 results, right? So each case, there's the case with no taxes, then there's the case with taxes. First there's the case with no taxes, and then all those assumptions, including no default risk. Then there's the case with taxes, but still no default risk. And then third, the last thing we did in the notes was case with taxes and default risk. And I gave you a formula. Very good, Kyla. Okay, so let's express that formula. Let's write it out. I'm going to put my iPad up. All right. Are you doing it without me? Do it without me and check back with me. So for the first case, I'm cheating. Okay, so that stands for financial distress cost. So putting in the numbers, VL is equal to 500 million. And I don't have to write the 6 zeros. I'm just going to put 500. I'll put it M just to remind myself that they all have to be M's. And then the taxes are 40%. And the B is 80 million. It's all in the case. I mean, all in the exercise. And then the financial distress cost is a function where I put E and then 80 million up there. And since throughout the whole thing, I've put M. I can just ignore the M. This is an M here too. Is that messy? Kind of messy. Can you guys see that? I can't make this bigger. Maybe, yeah, maybe I can make it bigger. I just can't make it smaller and I can't move it. Okay, so then when you put all that together in millions of dollars, you have to know how to punch this in your calculator, so make sure you know how to do that. And you should get 517.61 million. So confirm you can get that, let me know you got it, and then I'll do the next one. So they have two formulas, and so it'll give you a range of values. It's going to turn out to be about 500, between 500, it's about 520 million in either case. Okay, that's the first formula. The second formula I went too big and you can't see what I did. Okay, yeah, you did. Okay, so in the second formula, the value of the firm is equal to the first part's the same, the 500 million plus 0.4 times 80 million, and then minus the different function 2 ln of 80 million. And when you punch that in, you should get 523. So they're both about 520 million. Okay, so that wasn't the hard part. Well, even the second part isn't hard once you get it, but I have to show you how to do it. Yes, I'll always give you the PV of financial distress in the question. And the calculator with E, let me see, I have on here a calculator showing my iPad, right? I actually have the HP on here. I could show you the HP. Oh, the B2, oh, I have the B2 Plus, or some version of it. And this looks like the HP 10B2. Okay, so if I do it here, you know, to put in e to the 80 million over 30. You don't have to put the m. Well, I guess you do, right? You have to put the 80 million. I'm trying to think now. Do we have to put it? Okay, let's not put it. So e, on this calculator, e is, where is e? So it's second e. So I have to put a number first. So let's see if I put 80, second E. No, that's not what I'm going to put, because I'm going to put 80 divided by 30, right? 80 divided by 30 equals second E. There you go. Negative. Here's a negative. Do I use this? I don't know this I don't remember this calculator. If I use this, oh, you can't even see the calculator. Let me move it over. I have to make it smaller. There you go. Let's do that again. So this is at 10B2 plus HP. So it is 80 divided by 30 equals, and then second function E, and then I want to put a negative in front of it and add it to the rest, or I can just store it. Second store 1 on this calculator, and the rest I can do 500, so I say 0.4 times 80 equals, and I can store that in 2, and then I can go 500. So 500 plus recall 1, nope, that's wrong, plus recall 2 minus recall 1. There you go. I did it. Okay, so let's do that again. I'm going to start at the end because, well, I need to store those different components. So let's do this. If I store the last thing first, so 80 divided by 30, because everything is in millions, all the factors are in millions, I don't have to write the 6 zeros. So that's the exponent, and then second E, and I want to store that, second store 1. And then for the next part, 0.4 times 80, and I'll store that in 2, second store 2. And now I'm going to do the first part, 500, and I'm going to add recall 2, and I'm going to subtract recall 1. 517.61, okay? So I use the HP for people who have the HP. I don't have I couldn't get the TI on this, on the iPad. So where was I? I was here. For the logarithm, I think you have to punch the number and log. So practice that, punching it in. So let's do the challenging part now. Got to remember our calculus. Now I'll leave it here because you have to read the problem, right? Okay, so can I get to the calculus one? So is there an optimal amount of debt? That's the question. So I need to write out the function and then take the derivative of the function with respect to debt, because that's the choice variable. Then I set the derivative to 0 and I solve for B, the optimal level. Okay, and I have to be sure that that function is a concave function, so that there actually is an optimal, a peak. That's basically what I want to find. So the first derivative set to 0, the first derivative are the slopes of this function. So I take the first derivative and I set it to 0 and I solve for B. And then I should actually check, what should I check? I should check that the second derivative at B is actually a negative, to make sure it's a a concave function. See if I have to do all that. Yeah, I did write that in the solution, so we're going to do all that, okay? So the second derivative has to be less than 0. That's basically all you need to know, and you need to know how to take derivatives. And I gave you the formula sheet to remind you. Now you all took calculus, so you should know that. I think you all took calculus. Unless something dramatic changed. Okay, so let's get to it. So if I write out the function, the value of in the first case, the value of the levered firm is equal to, oops, okay, it's equal to the value of the unlevered plus TCB minus E to the B over 30. That was what we were told, right? So I want to take the derivative of this with respect to B. So this is just a constant. That's just going to go to 0. This is just going to leave the tax rate. So this is the only thing we have to differentiate. So when I do this, you can't see you don't see my 0 on the screen. Let me move this over a bit. There you go. So this is just going to be 0. This is going to leave TC. And then this is going to be what? The derivative of e to the something is what? It's just the derivative of the exponent, which is 1 over 30 times e to the something. Now you can review, like I said, the derivative rules. You don't have to do this fancy, limit way to calculating derivatives. All you have to do is use the rules, and that is the derivative. So now set this to 0. We know the tax rate is 0.4, so we can put that in. Actually, I probably should have put it in above, not to confuse you, to avoid confusing you. And so then this is b to the 30, b to the over 30. And solve it. Tell me what the answer is. So you just have to look at your, you get to look at the rule sheets I shared with you. You won't be, you don't have to go back to your calculus textbook, I hope. Just use the calculus handout I shared. Notice, before we continue, if we shouldn't even waste our time unless the second derivative is negative. Notice it is, right? If this is the first derivative, now take the derivative of this will be negative. So it's worth solving. Otherwise you would be wasting your time. Figured out how to do that. Okay, so now so you thought you'd never use calculus, and here you are. So now you solve for b, must be 30 times, so messy, 30 times log 12. What do you get? Is it too small? So B in dollars is equal to a lot. 74,547,000. And so there's more. 199. Okay? And that's it. So the only challenging part is that you remember how to take a derivative and how to use it. You guys get that? Are you guys still awake? I don't hear you. Very good. Andre got it. They are random. The questions will be random, Senna. Yeah, they're going to be randomized. So you'll have to be able to identify them. Yeah, you have to be very organized for Monday. Okay, I know. It's 5 weeks. This is a tough course in 3.5 months. And doing it in 5 weeks, you guys are incredible. So hang in there. You're almost done. You're almost done. You'll feel better when you see your test 3 results, right? I know you will. It'll really be almost over. Okay, how you guys doing? The long answer, you know what, I'll tell you once I make the test. I mean, I have the test questions, I have to organize them. Or anyway, I have to revise them. So I'll let you know after, I'll send you an email. Don't worry too much, just learn everything. Just be organized and learn everything. Okay, for the second exercise for part B, part 2 of part B, it turns out the logarithmic function is not concave. So when you check it, so part 2, it's going to be the same thing. You're going to write VL equals VU plus TCB minus 2LB ln B. And you take the first derivative, remembering this doesn't have any B in it, right? So this goes to 0. And this is just going to be TC. It's always going to be like that. And then this one, remember the log of the derivative of the log, look on the calculus notes if you forget, is going to be like that. Or, if I write it a different way, I could write it like, it'll be TC minus 2B to the negative 1, right? Is everybody okay with that? So when I take the second derivative, like you should go through the whole process and solve it, but I'm going to show you just a shortcut. If you take the second derivative, this has no B in it, so that will be 0. And then this part, the derivative will be plus 2b minus 2. So because this ends up being non-negative, it's not a negative ever, the whole function is not concave. So what you actually should do is you should solve this part, set it to 0, and solve for b, and then plug the result into the second function. But in this case, it turns out the whole function, the entire function, is positive. The second derivative is positive, so it'll never be a negative. I already told you that you cannot go back once you've answered a question. I have told you guys that. I'll write that. You'll see all the instructions, right, when you see the test. But yeah, you cannot go back. It's only one direction. And the questions are random. And what else? You want them in order, they're random, so I can't make them in order. You can't go back, you just gotta answer them as they come. You just can. Yes, it's an easy one to calculate, isn't it, Alan? So what we would call this up here B star, that's basically what you want to find. And what you're supposed to do then is plug B star into the second derivative to make sure it's a negative. So you should take VL with B star inside to make sure it's less than 0. Okay? So that's what you should be doing. But it turns out in the first problem, the second derivative is always negative, so that will work. But in the second exercise, the second derivative will always be positive, so it will not be an optimal. So this function goes down with a negative second derivative, an unhappy face or a negative smile or frown. And here, this one will, it's not necessarily going to go up, but it's just not concave. The questions between 30 and 35 questions on the test. Okay, so check out the answers for that. And now I have to tell you about, wow, it's 10:40. Now there's the last bit. What if you don't just have corporate taxes, but you have different kinds of taxes? Right, so this one, in this case, there's an optimal debt here, and we found it at $74 million in the first exercise. In the second, there is no optimum. I can't write it there. So in the second one, the function just keeps increasing. It's a logarithmic function that just keeps increasing. It doesn't go down ever. So I have my computer is freezing. Hold on. Okay, 7.7. So you guys should be able to do this stuff. Okay, these questions up here. There's different rates. There's personal tax rate. I'm going to show you the last handout I gave you. I'm here. I'm just going to flash this in front of you. So the last handout I gave you, 7.9, it adds in personal taxes, So there's tax on dividend income and tax on debt income. And I explain how this affects the value of the firm. Let me show you that. Okay. So imagine, in addition to the corporate tax rate, there's a personal tax rate on interest payments to bonds. So this is for the bondholder, right? That they have to pay tax. What if they have to pay personal taxes on their interest payments to so as a bondholder they get their interest payment, they have to pay tax on it. And what if you have to pay dividend, an investor has to pay dividend taxes, right? Taxes on equity income. So shareholders would receive each year, you would see that they would get, okay, so this would be their earnings after interest, and then this is after taxes, both corporate and their dividend tax. Bondholders would receive their interest payment after their taxes, right, that they pay out. Therefore, the total cash flow to all stakeholders would be this amount. And putting this together, algebraically, I can get this expression here. As a result of what I have to discount, the first portion is discounted at the rate of return, the required rate of return to equity. And the second portion is discounted at the required rate of return to bondholders. So this is yield to maturity after taxes. And this is the required rate of return to shareholders. And when you simplify, we can express the first part as the value of the unlevered firm. So this would be the value of the whole thing. We could call the value of the unlevered firm. And then this simplifies to this amount. So all that crazy stuff up there, all these formula, just ends up in this formula. So this is now the new value of the firm. So this is the fourth case. If you have, so you don't have to prove anything above, right? You just need this result. So this is not just corporate taxes, but personal taxes on equity income and taxes on interest payments to bondholders. So with all of that, you would use this formula. So I have you using this formula. Now if I add in, so this is before distress costs, and this is the full valuation with taxes, all kinds of taxes, and then this would be separate from the cost of financial distress. Sometimes you might read about what's management shirking or perquisite consumption. This would be where management is just, they just know the firm is going to shut down, so they're shirking. They're just not doing their job, or they're making decisions. They're not showing up. They're interviewing for other jobs, and so anyway, if you get information about that, that would go here. And then any information about other financial distress costs would go in this portion. So these are just other special cases you might see. I just wrote about it here. I think this is in the textbook. And so that's where it comes from. So you don't have to derive it. You just have to realize this is the result of having more than just corporate tax, where the investor also pays taxes on personal income. Okay? So you have all these formulas and you have many examples. I will be available to answer questions by email. I will send you an email with, once I've put the exam together, finalize the exam, because I only have it in a draft form. I'll let you know what I can let you know. But you should be able to complete the exam. It is open book. I'm not going to make it any harder because it's open book, because you still just have 3 hours. Okay. I will stay on for another few minutes if you want to stay on and ask me questions. And otherwise, I just refer you to watch the video again. If you didn't follow some of the instruction, I will be leaving it up. Probably again, YouTube will cut the video at 2 hours, so I'll have to repost the whole video and the chat might disappear. I'm not sure what YouTube is up to, but it doesn't really speak to me. It just does what it wants. But I am able to find the full video, except at a price, because I lose the chat, and I don't know if the quality is exactly the same. Okay, so good night to everyone who needs to get going or wants to go. Anyone else who wants to stick around and ask questions, I'll stay back for a bit. It was a pleasure teaching you. Okay, I'll be available. You guys can ask me questions on the weekend. You have my number. If you want to text, you can email me. I'll be online though. I'll be checking emails. Good night. Good night, Hannah, Susing, Senna, Alan, Sayamben. Thanks for sticking with me. Good night, Lenora. Good night. Okay, Kyla. No, who's asking? Kyla, about question, sorry, review 1, question 1. Go ahead. Thanks, Al. So the y-axis is first column, right? Sorry, let me go back. Yeah, the first column. Let me make sure. Let me make sure. My computer doesn't like that I'm opening too many files. I gotta close some things up.
Oh, I'm going to send you this spreadsheet too. There it is. Oh, it has a memory. I already closed that file. It's funny. Hold on, I'm just trying to open the document. All right. Review 1. Okay. So the first column is a proportion. So percent of, no, this is proportion of equity financing, and this is the percent of debt financing. Oh, it's opposite. Right. To get the graphs in our notes, you would have to use the same variable, right? So what's the variable that we had for the graph in our notes? This is saying percent of debt financing. So for the first graph, I'm going to flash it. You still there, Kyla? Okay, so the first drawing, you see that the debt equity ratio is on the horizontal axis, but the exercise stipulates percent of debt financing. So you're going to put this is the proportion of equity, so it would be the opposite, right? It would be the complement. So this is 100% equity, the first one, so it would be 0 debt. So that would start here. Got it? So you would start the first column here and move this way because it's the opposite. If you want to make sure it looks like this drawing, then you must have the debt equity ratio on the horizontal axis. Okay? Yeah, just read carefully. It's a good question. Which one should I put? So if you want to see this graphic, put this on. I don't have the graphic in the solutions. I don't know. I can't remember what happened there with that. But I should probably change it so it looks like this and put the debt equity ratio in there. I think I found an error or something and then I just never fixed it. But yeah, if you want this plot, if you want to see this, you'll be able to see this if you plot debt to equity. So you'd have to calculate all these as I showed you. Right. And then cost of capital would be cost of equity or cost of debt. That's right. And the WACC would be on the y-axis. Good night, Tony. You're already gone, probably. Thanks, Michael. Thank you for the summer. This went so fast. I commend all of you for doing this in 5 weeks. I couldn't imagine. Okay. Any other questions? Take care, Kyle. Take care, everybody. Good night. Make sure you have a good rest before the exam, the night before. Have all your papers organized. Okay, I'm gonna sign off. Bye.